All right, so let's talk about what just happened. Because if you have even a dollar in the markets right now, this is not something you can afford to ignore. What we're witnessing isn't just another headline or another overreaction. This is one of those moments where the rules people thought they understood suddenly feel very shaky. Trump has officially confirmed that Jerome Powell is on his way out as head of the Federal Reserve, and the replacement is not who markets were pricing in at all. Almost instantly, stocks sold off, gold and silver experienced historic drops, Bitcoin rolled over, and the entire idea of easy money started evaporating in real time. That reaction alone tells you how deeply unprepared the market was for this outcome. Now, when news like this hits, it's easy to get caught up in the panic or the excitement, depending on which side of the trade you're on. But what really matters is understanding why this reaction happened, what it actually means beneath the surface, and how this changes the investment landscape going forward. Because moments like this don't just destroy capital. They also create opportunity, sometimes the biggest opportunities you'll ever see, but only if you understand what's really going on. At the center of all of this is the incoming Fed chair, Kevin Warsh. This is not a random pick, and this is not a neutral pick. Warsh is someone the markets know very well, and not necessarily for reasons they like. He served as a Fed governor during the Great Financial Crisis, right in the middle of the chaos when the system was on the brink of collapse. That period shaped his entire economic worldview. While the Federal Reserve was rolling out bailouts, backstops, and emergency liquidity programs to keep banks alive, Warsh was already worried about the long-term consequences. He believed stimulus could go too far, that interest rates were being held too low for too long, and that the seeds of future inflation were being planted even back then. What makes this so important is that history tells us how someone behaves under pressure. In 2010 and 2011, when inflation was quiet and markets were begging for more stimulus, Warsh was warning about runaway inflation and currency debasement. When the Fed announced another $600 billion of stimulus to support housing, he opposed it publicly, calling the benefits small and temporary and the risks large and long-lasting. And when he realized he couldn't stop the money printer, he didn't compromise. He resigned. That decision cemented his reputation as someone who would rather accept slower growth and falling asset prices than risk destroying the dollar. Fast forward to recent years, and that philosophy hasn't disappeared. In 2022, Warsh openly criticized the Fed for waiting too long to raise rates after the pandemic. He argued that overstimulation destroyed the Fed's credibility, inflated asset bubbles, and widened inequality by disproportionately benefiting asset holders. His core belief is simple but uncomfortable for markets. Stability matters more than short-term gains. A strong currency matters more than record stock prices. And easy money, in his view, always comes with a painful bill later. That is why markets reacted the way they did. Investors were positioned for a continuation of the world they've known for over a decade. Low rates, constant liquidity, predictable bailouts, and a central bank that steps in whenever markets wobble. The expectation was that Trump would push aggressively for lower rates, keep the economy running hot, and let asset prices continue climbing. Instead, the nomination of Kevin Warsh injected uncertainty into that narrative overnight. This is what people mean when they talk about the Trump effect. For the past year, Trump has repeatedly criticized Jerome Powell for not cutting rates fast enough. He's been vocal about wanting cheaper money, stronger growth, and policies that juice markets. Investors believed him. They positioned themselves accordingly. The assumption was that the money printer would keep running until inflation made everyday items absurdly expensive, but asset prices would continue higher. That assumption just got challenged in a very serious way. The fear now is that Warsh comes in and does the opposite of what markets want. That he tightens financial conditions, reduces the Fed's balance sheet, and prioritizes the dollar over stocks. In that scenario, a stronger dollar pressures equities, commodities, and crypto. Liquidity dries up, risk assets reprice lower, and suddenly, the playbook that worked for the last 10 years stops working. But here's where things get more complicated and more interesting. Kevin Wersch today is not exactly the same Kevin Wersch from a decade ago. Recently, he's talked about lowering rates to spark growth, specifically pointing to housing. He said that lower rates could make 30-year fixed mortgages affordable again and help restart the housing market. He's also positioned himself as an ally to the White House going into 2026. That has led some people to argue that he's softened his stance or that he's simply saying what he needs to say to get the job. So, which version do we get? The inflation hawk who prioritizes the dollar at all costs, or the pragmatic policymaker willing to lower rates to support growth? The honest answer is that no one knows yet. And that uncertainty is exactly what markets hate the most. Markets don't usually crash because of one event. They reprice based on changing expectations of the future. When investors can't confidently predict the policy environment, they demand a higher risk premium. That means lower prices. Add to that the fact that markets almost always overshoot in both directions, and you get the kind of violent moves we're seeing now. We saw this in April 2025, when fear drove prices far below what fundamentals justified. And we saw the same thing in reverse when optimism rushed back in. This kind of volatility feels dramatic, but it's actually very normal. Every single year, markets experience meaningful drawdowns. Even in years that end up being great overall, you'll often see 10 to 20% declines along the way. Since 1980, the average intra-year drawdown for the S&P 500 is over 14%. And yet, in the vast majority of those years, the market finished higher. What's even more telling is how rare truly catastrophic years are. Going back to 1950, only a handful of years ended with losses greater than 15%. Most of the time, markets either recover quickly or never fall that far to begin with. The average recovery time from a 5 to 10% drop is just a few months. Even a 10 to 20% correction typically recovers within 8 months. And yes, recessions happen, and they can be painful. But even then, the market historically recovers within 1 to 2 years. This is why trying to time exits and re-entries is so dangerous. Investors who panic sell often miss the recovery. Those who stay invested and keep adding during uncertainty tend to come out far ahead. The data is brutally clear on this. The longer your time horizon, the higher your probability of positive returns. Over 15 years, the chance of making money in the market approaches certainty. That perspective is critical right now, especially as people watch gold, silver, and Bitcoin fall sharply. A lot of investors treat these assets as safe havens or hedges against chaos, so when they drop alongside stocks, it feels especially alarming. But this too has an explanation. A stronger dollar puts pressure on commodities priced in dollars. Tighter financial conditions reduce speculative demand. And when leverage unwinds, everything gets sold, even assets people thought were untouchable. This doesn't mean the long-term case for these assets is broken. It means they're repricing in response to a shift in expectations. If you didn't plan to sell anyway, lower prices aren't a disaster. They're a discount. This is where mindset matters more than headlines. It's also important to understand the political tension underlying all of this. Trump, despite his rhetoric, actually benefits from a weaker dollar in many ways. A weaker currency makes U.S. exports more competitive, supports stock prices, and makes government debt easier to manage over time. A strong dollar does the opposite. It hurts exports, encourages offshoring consumption, and tightens financial conditions. That creates a fundamental tension between Trump's economic goals and Wersch's historical philosophy. So what happens next depends on how that tension resolves. Does Wersch prioritize long-term currency stability, even if it means short-term pain? Or does he align more closely with the White House and lean into rate cuts and growth? The market is trying to answer that question right now, and until it does, volatility is likely to remain elevated. This is exactly why periods like this can be so powerful for investors who stay rational. When uncertainty rises, prices fall to compensate. That creates opportunity for those willing to look past the noise. Historically, investing during periods of fear has been one of the most reliable ways to generate long-term returns. That said, uncertainty also makes personal financial discipline more important than ever. When returns are harder to predict, controlling what you can control becomes critical. Knowing where your money is going, cutting unnecessary expenses, and staying organized financially gives you flexibility and peace of mind when markets get rough. Now, bringing it back to strategy going forward, here's the part most people care about. What do you actually do with this information? First, understand that volatility is not the enemy. It's the price you pay for higher returns. Second, accept that no one can predict short-term moves with certainty, not even policymakers. Third, recognize that history overwhelmingly favors patience and consistency. Over the years, there's been a clear pattern. When optimism peaks, people chase returns and ignore risk. Prices disconnect from fundamentals. Then something changes, fear takes over, and assets get dumped indiscriminately. That cycle repeats again and again. The people who lose are usually the ones who react emotionally at both extremes. The people who win are the ones who stay the course. I've seen this play out personally. During major downturns, assets that seemed unattainable suddenly became affordable. Those moments felt terrifying at the time, but they ended up being once-in-a-lifetime opportunities. The same thing happened during the pandemic crash, and again during the 2022 sell-off. Buying when fear was high felt uncomfortable, but it paid off over time. As for Kevin Wersch specifically, my personal view is that the market is likely overreacting. Trump is not going to appoint someone who fundamentally works against his agenda. That doesn't mean Wersch will blindly follow orders, but alignment matters. At the same time, history reminds us that policymakers can be wrong. In 2007, Wersch said credit risks were minimal right before everything collapsed. So humility is warranted. The key takeaway is this: anything can happen in the short term, but over the long term, staying invested, continuing to buy, and resisting panic has been one of the most reliable strategies ever discovered. 20 years from now, none of this noise will matter nearly as much as whether you stayed disciplined. So if you're watching markets fall and feeling uneasy, zoom out. Ask yourself when you actually need the money. If it's not soon, short-term price movements are mostly irrelevant. Lower prices today may be exactly what future you ends up being grateful for. And that's really what this moment represents. A test of patience, a test of conviction, and potentially the beginning of a very different market environment. Whether that ends up being painful or profitable depends largely on how you respond. If you enjoyed the video, like, share your thoughts in the comments, and subscribe to the YouTube channel so you don't miss out on the next important analysis update. Thanks for watching, and I'll see you in the next one.